Paul, welcome back. After our last conversation, I actually took your advice. Now, you mentioned to me that HHIS probably didn't really belong in my emergency fund. And honestly, the more that I thought about it, the more I realized you were probably right. And that got me really thinking about something a lot bigger. So we're late start investors, and I'm wondering if late starters are taking maybe a bit too much risk by trying to generate income too quickly. Because after doing my last video on Cage, which some of you have probably watched, and rebuilding my emergency fund, I'm starting to wonder if people close to retirement may actually need a bit more growth, but also more simplicity. So today I thought we could talk about that type of issue that people are having. And you mentioned to me before we got on camera here that you have a bit of a dilemma when it comes to some of your positions.
Hey, Darren. First of all, welcome. Thank you for welcoming me back to your channel and doing another monthly update of our growth versus income. And yeah, I do have a dilemma, and I don't know if you want to go into that right now or you want to leave that for a little bit later on in the video. It's up to you.
Absolutely. Let's dive into it.
All right. So, Darren, I'm looking at my portfolio, and as you just stated, maybe us older investors are taking on a little bit too much risk. And for me, that risk would be investing in single stock ETFs, which when they're doing well, accelerate quickly in share price appreciation, and the dividends are fantastic. But on the downside, when things like Bitcoin crash or the tech bubble crashes, they drop exponentially faster, and so does their distributions, leaving me, of course, with less monthly income than I was making before. So now I'm thinking, I want to build up my base. I want to buy your steady eddies. I want to buy foundational ETFs like your HDIV, HYLD, HHIC from Harvest. I've been buying lately, stuff like that. But at the same time, those ETFs all seem to be at all-time highs at the moment. So I feel like I'm overpaying for them. And if there happens to be a crash, like some finfluencers, say, for example, Perry has been calling for since January, if that crash comes along, I want to scoop up those at a cheaper price. So right now, to be honest with you, I'm a little bit stuck. I'm not even sure what I'm doing.
Interesting dilemma to have, because that was in my emergency fund experiment, which is what I was leading into with the intro there. That foundational position, I thought, as a covered call, as a sort of a newbie income investor, HHIS, I thought, oh, this is new. I can add this in and let's see how this does. So that account used to have HHIS. It had USCL and HYLD, 50% in that part of the portfolio of the $11,000. And then the other part was in XEQT and VFV. And then after we talked last time, you were mentioning how HHIS is such a concentrated position. So I think it lends well to what you're talking about. Now, it's not a single stock, but if anybody knows anything about HHIS, it's actually made up of a lot of individual holdings. So it has like 19 or 20 positions, but those are all in single positions. And so that's what makes that particular fund up. Now, when I bought into that one, I guess you could say it was me trying to generate some income within a little bit of an experiment, but the price of that fell quite quickly and I was listening to your video with Perry, and you talked about the tech, what was the term you used? The tech, not freeze, but the tech stall in October?
In October was the crypto chill. I don't know.
Right, the crypto chill. That's what it was.
I don't know who comes up with these names, but the crypto chill, right, where Bitcoin dropped literally from $126,000 down to in the low 60s. Which, if you held any ETFs with Bitcoin as the underlying holding, you can imagine that they all plummeted. And
right.
along with the share price or the NAV depreciation, so went the income.
Yeah, so here we are. I'm dealing with this HHIS thing. I decide, you know what? It's time to move on to it. And you made some good points, because it's a very concentrated position. And what happened in October is exactly what happened to that share price. And even though the distributions were flowing in, which we know is some of it is obviously the cash that's generated from the cover calls themselves. But obviously, when those things change and they can't keep up with paying, then you're getting some of your own capital back. And I think that's why I wasn't seeing the movement in that account. So I went ahead and I made those changes in that account, and I bought HDIV, and that's how I balance it out. So now it's HYLD. It's a roughly about 2,800, I think, in HYLD and HDIV. And interestingly, since I made those changes, now this month's been a bit of a crazy month.
Yeah.
I went from the negative. So the balance in that account was supposed to be $11,000, and we were supposed to see some steady increase. That's what I was hoping for. And yeah, it was my emergency fund. Um, so since last month, I was down about, I don't know, was at 10,800 or so. And right now, as we're talking, it's sitting around 11,800 after I made that change. So here's an interesting thought, because your dilemma is, do I wait and do I buy this foundational position or these other positions when their price is lower? Um, I don't look at it that way. I just buy it at the price it's at every single week, because the runway I have for that portion of the portfolio, it's not just 7 years to when I retire. It's far longer than that. So it doesn't matter, in my opinion. It's like dollar cost averaging, right? You're going to see ups and downs as things go along. Now, this is where I guess the conversation gets interesting from the income investor's lens. Is you are trying to balance your yield, is what you said.
Yeah. So, Darren, you make a good point there that we do have, I guess, a long runway, and maybe I shouldn't be focusing on the share price like today. If, say, for example, HYLD is up at $15 a share and I want to buy it at 13, but who knows, maybe in 10 years from now, it'll be at $20 or $25 a share. And you'll look back on it and say, hey, 15 was a good buy-in opportunity. So, it's tough, especially with this looming crash that everybody keeps talking about. Maybe I should stop listening to people talking about the crash, whether it's going to happen or not happen. With regards to HHIS, just to remind people what you and I were talking about, the problem with it in your emergency account is if you ever had to sell shares in order to pull money out, right? You wouldn't want to have to sell your HHIS when it's down 20%. Whereas for myself, I have HHIS in all of my portfolios, and it's not a problem because I'm only pulling the income out. I'm not actually selling any shares. So whether it goes up or down doesn't really make much difference as long as the distribution stays fairly consistent. Does that make
Yeah, that's
sense?
actually a really good point. And I did have some pretty strong comments of people in my last month end video
Some
where I talk
haters?
about this where the experiment is failing quite miserably as far as emergency fund. And people are saying that's not good advice. And I've said all along, guys, we're not financial advisors. Okay, this is just two guys that get together and talk about our interests in investing. And this is, like Paul said, this is us talking about the differences between growth and income. But at the end of the day, I thought it was an interesting experiment with my own money, just to see how this might
Yeah.
go. And the truth is, starting, because it started around October, I believe, is when I started putting money into it. And if it was truly your emergency fund, it's a terrible idea. Even and by the way, this was suggestions of people that were watching my channel that, why do you need an emergency fund? Why don't you just invest it? And at the end of the day, I don't believe that. I think that's actually not a smart move at all. But I'm still interested to see how it performs, even with the changes that I made. I haven't put any money into it since it's been about 4 months now. And so we're up about $800. But of course, we've had a couple months where it's been below the 11,000 that I had got it up to as far as the capital goes. Now, long term, like you said, Paul, these are the things that you have to think of more long term. So emergency funds can't be long term, right? I need that money today. The dishwasher went, or whatever the case may be. I need that
Yeah.
money tomorrow. And like you said, I don't want to be selling shares to make that happen. So anyway, it was kind of an interesting experiment. I'm curious to see though how HDIV does. Now, on the other hand, it's also in comparison to those two growth funds, XEQT and HDIV, or pardon me, not VFV. That's the other one
VFE.
that's in there. Yeah.
So how's it doing comparatively?
They're pretty. Well, now that I've made the change, and I only made it like 2 weeks ago, so it's really hard to measure specifically how they're doing against each other. The VFV and the XEQT positions obviously have grown far outgrown in share price. The two covered or the three covered calls I originally started with. Um, and maybe that was because there was such a downturn, right? Since October, it really hasn't been great. This last month, even the last couple of weeks has really been strong. I've seen some
Oh yeah.
big increases in my portfolio, and I think you've seen that too, right?
Oh, I have for sure. And I got lucky, Darren. I timed a few things well, which I don't always do, but I timed a few things well. For example, in one of my portfolios, I decided to get rid of Alti, one of our our favorites, and QDTE from Roundhill. Now, I still own both of those in another portfolio. But in this one specific portfolio, I got rid of both of them and I bought only MSTE at a very low share price. And when I did that, the account balance was around $5,900. It's currently over 8,000. It's grown that
Wow.
much. And yeah, it's grown that much and I'm going to say maybe 2 months now. It went from 5,900 to over 8,000. I've had 2 months worth of dividends. It's on drip, so I get more shares. But the price appreciation just going up like 50 cents or a dollar. But when you have 1,900 shares, if it goes up a dollar, right, you go up another $1,900. So it's been great so far.
Now, I'm
I'm
curious then. So, if you sold two positions to buy into one, um, what happened to your income then? Because that's your focus. So, was it a big change?
No, it wasn't really a big change. MSTE still pays, it might even pay more than the two of those, to be honest with you, because for like for an ETF that only costs $4, I think I paid less than $4 a share. It's still paying 15 cents a month. So it actually does, it's probably about a 50% yield, I think. Yeah.
So effectively, by selling the two funds that you did and buying into another one at a lower price, because that sounds like what you're up to is you're selling two funds in order to capitalize on that, and that's what you mentioned before is do I buy at a lower price, right? That and so it sounds like that's what you've done. You've seen some appreciation in price, and I assume that the income part didn't change.
You know
Yeah.
what? I haven't sat down and actually looked at the income of just that one. It's a RSP that I have in RBC. It's a very small account. I think maybe, well, I just told you it was 5,900 when I made the changes, and now it's just a little over $8,000. Yeah. So income wise, I don't think, but I think as I drip more shares, and if MSTE continues to recover, then eventually the income will far exceed what I was making beforehand.
Right. Interesting.
I kind of tried to catch MST at the bottom, right? It was at such a low point, and you could see Bitcoin's been going up recently. So I kind of timed it that way.
Right.
Yeah.
Now, here's something I was thinking quite a bit about. So, a lot of people they think about income investing, and they automatically, in some ways, they think that things can be safer if you're a growth investor, right? We've heard that term, like, oh, it's safer. But I'm not sure that's the case. Now, do you think that with income investors, how do you look at safety?
Well, you have to look at the ETFs that you're buying, right? For example, we were just talking about MST. Everybody knows strategy. And, so MSTE uses leverage and it holds strategy, which uses leverage, and it holds Bitcoin, which is the most volatile asset there is. So there's not a lot of safety in that, right? I mean, if you believe in strategy long term, then you believe that you will do well in the long run. But there's not a lot of what we would call safety in that. Versus if you're investing in a covered call ETF where the underlying holdings were, say, Canadian financials, right? A lot more safer. I mean, obviously their equities, they can still go down. I mean, we've seen periods, I think 2022, 2023, where the banks kind of got crushed, but they recovered. Or for example, utilities, you know what I mean? You can invest in utilities, or you can just go with something like the S&P 500, or even something like XEQT. You were talking about the video I did, whether I would sell XEQT to buy HEQL, right? HEQL is globally diversified with leverage. So really depends on what the underlying holdings are.
Do you think that emotions plays a big part in that, like as far as what you do with your portfolio and the safety piece?
Yeah, I guess so. And I think it's individual. I know you and Carr were kind of talking about this, and it's for some reason certain people have a preference of wanting to be growth oriented, where other people feel that sense of safety when they see the distributions hitting their bank account. I guess it's just personal preference, maybe psychology and what makes you feel more comfortable.
Or I think that like if this my emergency fund experiment, I'm pretty confident that if that was truly my emergency fund, and at the time when I started it, it was, I couldn't sleep at night with something like that. That being as volatile as it was, it's still an interesting experiment. But I truly believe that your emotions do play a big part in what you do. And I would think like even for me as a growth investor, um, if I see a stock that's not performing well, and in my case, I bought maybe a handful of single stocks when I first started, and I didn't really have a path. I didn't really know what I was doing at the time. I completely have a better understanding of what I would do differently, but there's ones in there right now that are not doing well. Stay tuned for my next monthly update where you'll see what I did with them. But I did sell one of them, and it's not a terrible company or anything like that. But emotions wise, I was thinking this stock is not doing very well. It's also encapsulated in one of my other ETFs. Why do I have that overlap? And
Oh, I
so
think I know what you're
I made
talking about.
I made some changes, and it goes right along with what you mentioned about HHIS. It does create overlap. It's a concentrated overlap, right? Because
Yeah.
in the other holdings, like for instance on the growth side in VFV, all of those holdings that are in HHIS are in VFV. So the strategy behind it is obviously something completely different, but I think people's emotions do play a big part. And like you said, if you can sleep better at night, if you feel better investing in something, that's far better than going to sleep and being worried about it all the time. And that there isn't, and I think Carr mentions that too, right? Where he's not saying that one is better than the other, like growth is better than income. It's just simply what works best for you. And as you learn more, adapt.
Yeah. And Darren, I don't know about you, but like I was saying that I did a second move that worked out perfectly. And I'm going to be honest, this was a lot of luck and just people kind of saying in comments like, "Hey Paul, why don't you take a look at this ETF? Why don't you buy this ETF?" And finally I decided to sell out of my I had an ETF from the States called AIPI, which
Hmm.
obviously was AI stocks. But the problem with that particular one was I think they were writing too much on the portfolio. So whenever the market would crash, it never really recovered, right? So say it started at $40 or $45 when I bought it, and then the market kind of went down in April or whatever it was, and it went down to 35. Well, then it only went back up to 40. So my cost is 45, but then it went, and every time it would go down further, it would never quite get back up again. And
Right,
they're paying a 35% distribution on that
right,
share price or the NAV. So you're always getting a 35% yield, but you're getting a 35% yield of a lower share price all the time. So I finally
right,
decided to cut it loose, get rid of it, and buy Chippy from YieldMax. And
right.
Chippy holds semiconductors. And it was at $60 a share. I happened to buy it one week when it dipped down to 55. And I don't know if you've seen it recently, but it hit about $75 a share.
Wow.
Honestly, Darren, it was just luck. If you had asked me 6 months ago, "Hey Paul, are semiconductors worth investing in?" I don't know. Right. See, this is the thing. I don't know about you, Darren, but I'm not really the type of person who can analyze stocks and foresee the future and predicting what AI is going to need and which companies we should be investing in and you know what I mean. Otherwise, we would have been picking the right stocks like Palantir, Nvidia, Broadcom, Intel, right? Picking them at the right time at the right price, and we'd be rich. But I haven't had
I
that
do.
luck, so I find it's easier just to buy things like the S&P 500 or the Nasdaq, and you won't make as much money, but you still make enough money to live on.
So that actually opens up the door to another question that I just thought about, which you mentioned earlier. But the truth is, I think that's why it's much I don't say better, but over the long term for people like us who are regular investors, broad-based ETFs are definitely the way to go. And
Yeah.
we're not gonna split hairs here and say that if you like want some leverage and income, that's not necessarily a terrible idea. But like you said, I don't have the time. I am busy enough as it is to figure out which stocks I should buy. If I did that, I could probably make a lot of money. But at the end of the day, I can buy broad-based ETFs, capture all of the market,
Yeah.
and go from there. But it all made me think about what you suggested in your video that you did, because last time we talked, you mentioned that you had purchased XEQT. I think it lends well to the notion today about being a late start investor and where do you start? And even yourself as an income investor, do you need that sort of growth sleeve? But now you're looking at making a change. So why don't you talk a little bit more about that change?
Geez, Darren, I do 7 videos a week, and now you make me go back and think about the one I did. No, I'm just kidding. Uh, so, as you know, a while back, Sean and I decided we were going to buy XEQT and FEQT to have a little bit of growth in our portfolios. We wanted to do a weekly buy and compare the two just to see whether one outperformed the other. And ironically, one week XEQT would be a little bit ahead of FEQT, and then the next week it would, flip flop the other way around. Sometimes they were identical. You know what I mean? Like his portfolio, and we were buying at the exact same time, the exact same day every week, right? So yeah, so we were doing that, and then somebody brought, I think it was Leon from Leon's Money Flow. Shout out to Leon. You guys should all go and check out his YouTube channel. He's a great 25-year-old. I call him a kid because I'm old, but he's a great, very intelligent young man. I think his portfolio just crossed $100,000, which is pretty
Wow,
impressive for his age. But
absolutely.
anyways, he kind of brought to my attention HEQL, which is, I think it's from Horizon, from Global X. I think it's Global X, and it's very similar to XEQT, just with a bit of leverage. And I did a video kind of comparing the two and looked at the returns. And I mean, you can only go back as far as, I think HEQL has been around for 3 years. So you're only looking at 3 years with the data, which, as Carr always tells us, 3 years is nothing, right? You need like 10, 15, 20 years with the data. But it is actually above XEQT. So then I started thinking, well, maybe I should sell out of XEQT and buy HEQL, talk to Sean about it. And we decided, yeah, he would sell his FEQT, I would sell mine. But because the market's so hot right now, we're still sitting on the money, kind of waiting for a little pullback to put into HEQL. Plus, we're both income investors. So as soon as you sell XEQT, or for him, FEQT, and you're sitting on like $2,500, $3,000, it's like, if I put that into S Day, I could make another $200 a month in distributions. So, we kind of go growth for a little while, and then, we always go back to income. But we'll eventually get back into the growth mode and start adding to that position again.
So there were a couple things that I found interesting because I did watch your video. And one of them was you mentioned in the video that fund, HEQL, I think I got that right, has
Yeah.
some leverage. I don't think I've heard of that before when it comes to like all in one type of funds.
Yeah.
So is it 25% leverage on the portfolio?
I believe it is. And I think if you go and look at it, it just holds HEQT, I believe is what it is, right? HEQT, which like XEQT is just a fund of funds, right? It just holds other funds. So you get your, US, your Canadian, your Europe, globally diversified markets, all that. All it is it's as if you took XEQT and added 25% leverage. That's really all it is. And I'm pretty sure it is 25% leverage because that's pretty standard in Canada.
Right. And that's not writing call options. That's just simply using extra equity to purchase more shares. Is that how that works?
I think so. Yeah, I think so. Now
Interesting.
you
I'm gonna have to do a little
we're gonna
deeper
have to
dive
go
into
back and
that.
look.
Yeah, I'm interested. So I'm curious then, what is the, maybe you don't know this because I don't think you mentioned it in your video, but what is the MER on that fund?
Oh, that's a good question. You'd have to open it up and we'd have to take a look. I can't remember exactly what it was.
Well, maybe we'll
there
save
would,
that one for next video where we can maybe dissect that fund because it's kind of interesting, I have to say. And
yeah.
you also mentioned in the video that it pays monthly. So why don't we do that? Why don't we come back and we'll talk about that one next month where we can maybe dissect it a little bit from both of our lenses to see how it might work for someone investing later in life who maybe is looking at a bit of income or they want a growth sleeve. And I'll circle back to the growth sleeve a little bit because I think it lends well to the late start investing part of things that you need to think about. You have started this growth sleeve, and it got me thinking about my own portfolio, why I wanted to make certain changes in it, and long term. So when I did my cage video, which did really well, I was actually quite surprised how well that video did. Um, but I also learned a lot about that fund and realized I already had some of this factor tilting in there. Now, for those of you that don't know, factors, you know, they like value and momentum, they can take a long time to show up in a fund like this, where with XEQT, there's no tilting going on towards one of these. And so I was thinking, like, I only have 7 years till I retire. Why would I want to put my money into that now? But then I got thinking about it a little bit more as I analyzed that idea. And you and I were hinting at it is, yeah, I'm going to retire in 7 years, but I'm not going to draw down on all of my portfolio right away. There's going to be a good chunk of that money that could sit in that fund for that extended period of time because it could take upwards of sometimes 10 years for these factors to really show up. So that got me thinking, is that something that I should be thinking about more long term? So I'm curious though, is that something that why you introduced your growth sleeve? Because you realize like, oh, the timeline's a little bit longer for this portion of the portfolio.
For me, Darren, I like to every once in a while have something like XEQT in my portfolio where I buy it with distributions. So I'm not like taking money out of my paycheck or, have to contribute to my portfolio, but I just buy it with distributions and just kind of quietly in the background growing. And then, just like recently when Sean and I decided to sell our two growth positions, all of a sudden I have extra cash, like I have surplus cash that I can now throw back into my income portfolio. That's one of the reasons why I do it. I mean, initially when we bought XEQT, the plan was to hold on to it for like 20 years, but I'm telling you, that went out the window as soon as Carr sold his. It was like, what? Wait a minute. We're not holding this for 20 years. What's going on? So I like to tease him about that. I'm sure he's maybe seen it in a few of my videos where I talk about it, but just kidding aside, right?
Yeah.
What I'm wondering with you, Darren, I got a question for you because I
Yeah.
know when you started investing, you had a goal of hitting 500 and something like $70,000. And you thought that would take you right up until you retired at 59. And now you're 3 years in and you're almost at your goal. Have you started looking at adjusting like when you might retire? Because in a couple of years from now, your portfolio might be at six, seven, $800,000.
So it's interesting you say that. It is something that I have been thinking about. They do say that people need to retire from work to something. You don't just retire. I'm enjoying what I do on here to help other people, to motivate other people. I would love to see myself doing this a bit more long term. And yeah, this would be something that I could do in retirement and then, tend to other things that the family does. So that
Yeah.
is a distinct possibility. So yeah, you're right about one thing. The goal was to get to 500,000 from the original 220 that we started with. And then when I introduced the calculator that I was using to figure out how much I would need based on our the pension money that I would be bringing in and stuff like that, that raised it up to about 555,000. That's the actual number. And I just checked this morning, and the portfolio is sitting at like 543,000. So it's
Wow.
literally right around the corner, which is
Yeah.
fantastic. Now, with all of that said, I think something that's important to acknowledge, and you and I have been talking about it here throughout this video, and is the markets can change drastically, whether you're an income investor or a growth investor. And even you said it yourself, Perry's talking about this, drawdown that may happen. If I have just the bare minimum in my portfolio and there's a 20% drawdown and I'm not ready for that, or I'm not properly prepared, then that's probably not a good move. So I'm looking more long term thinking, okay, well, I need a buffer now, right? I need not only the cash wedge idea, but I also need a bit of a buffer to deal with that if that was to happen.
Yeah.
And then obviously I have two kids, and they were never really part of the calculation because we have our RESP for them, which by the way has reached the $110,000 mark, which is pretty awesome
Wow.
considering I wasted 10 years of time with their money where I didn't do anything with it. Because we started investing their money for that RESP the same time we started investing the money that we're investing. So that's
Nice.
another great milestone. But what if they become doctors, and what if they need help buying a home and all these other things? So I want to make sure that we have a decent buffer for dealing with those things. So I mentioned it in my last month end video. We're cranking in on that goal, but at the end of the day, I think we're going to shoot for 1 million. I think that's where we're
Oh, the
headed.
new goal, eh?
Um, yeah, we're going to set a new goal, but that doesn't mean that I won't consider the retirement thing maybe a little bit earlier either.
Yeah.
It is a possibility. But we'll see what happens over the next year. I didn't think I would get to 555,000 as quickly as I'm getting to it. Markets just, you never know, right? And the thing is, that accumulation phase, it's crazy. The momentum is nuts. After I put my tax return in, right, capitalizing on the deferral of wages now to later when you get tax less on it and all that. That was a huge increase in the income into the not income, pardon me, the capital that went into it. So yeah, I'm thinking about it, but we'll revisit that one in a while. I have a tough question for you, Paul, and well, maybe it won't be. I don't know. But so if you could restart your portfolio from scratch today, what's one thing that you would do differently?
Uh, from scratch, like going back how far?
Right from the start.
To start, I was like 18 or 19 when I started. I can't remember that far back. If I guess if I had to go back to even just say 2020, um, some of the biggest mistakes I made, Darren, were selling things. I bought stuff, they appreciated a little bit, and I got too, I don't know, maybe greedy or excited. For example, I sold CNQ when it was at $30 a share. I bought it at 19 during COVID. It went over $100. So I think I just need to learn maybe more patience. Um, maybe not trying everything, because I tried meme stocks, I tried penny stocks, I tried a lot of stuff where I lost everything, even if it was just $200 or $300 or $500 that I put into an investment, thinking, what's $500 when your portfolio is worth 200? But you know what? Every $500 that you lose, right? That much more that you have to gain to get it back again. So there's probably a lot of stuff I should have just stayed away from and just stuck with the basics. The more tried and proven methods of investing.
Easy to say now, though, when you have so much experience. Like I listen to you talk on your videos, and even now from when you and I started, I can tell that you are so much more well informed. I feel the same way. I feel like I have a decent conversation now about this stuff, where before you mentioned ETF and I probably would have looked at you like you had three heads. I think for me, just simplifying things is a great way to go, and that's why I've always said some sort of all-in-one is probably a really good place to start. It allows you to get your money working, and then as you learn more about investing, you can change your core ideas. And if you want to go into get some income funds, or if you wanted to go after some single stocks or whatever the case may be. I know for me, I got caught in that whole yield chasing thing. That's a big one. I had some of those yield max funds, it was
Oh yeah.
experiment, but less of that kind of thing. And the big one that a lot of people have been pointing out to me is the overlap in my portfolio. That's something I really missed, is that overlap, thinking that, well, if I have, for instance, the S&P 500 and I have the NASDAQ, well, that can't be a bad thing. Well, it not necessarily is bad, but if the percentage, for instance, if I want 30% in US and all of a sudden I have 30% in the S&P, and now I add the NASDAQ, you're overweighted. So I
Right.
think in those regards, I wish I'd known a little bit more about that stuff, about your asset allocation, what those percentage of holdings would look like, and just understanding how all that overlap really looks. Now, that doesn't mean that if you didn't get you mentioned semiconductors, right? If that was the hot topic and you had the knowledge and you wanted to buy a company, I don't think there's anything wrong with that, but you need to be well informed before you make a decision and buy a single stock like that. I know now I wouldn't suggest to anybody buying single stocks, because I would just simply tell them, I don't have the knowledge. You need to figure that out for yourself before you go buy a single stock. And I
Yeah.
think what got me into that was dividend investing, because that's where that notion came from. Well, you have the Enbridges of the world and things like that. So, because a lot of positions, I even held Coke in the beginning. I had
Yeah.
Disneyland when I
Yeah.
first started. These are all dividend payers. But at the end of the day, that's too much to manage, and I get those in the S&P and these other funds that I hold. So there wasn't any point in that.
I mean, ironically, though, I don't know if you follow any American YouTubers or finfluencers, but there are a few guys like Ryan and Ian from his channel PPC Ian, I think it's called. They're both dividend growth investors, and that's all they do is buy single stocks, and do very well at it. But I mean, that's their bread and butter, right? That's what they research. You know what I mean? That's what they buy and hold, and they've done exceptionally well doing that. But like that. I think that's part of it, Darren, is you have to pick a strategy and stick with it, right? You can't be constantly looking for what's popular today. You know what I mean? Oh, hey, I heard guys are making money on Bitcoin. I'm going to go all in on Bitcoin. And then next week, well, I heard Darren's buying Cage. I'm going to go all in on Cage, and just keep flip-flopping strategies. That doesn't seem to work. But
That's
what
actually a really great point. When you started, you went income, right? That was where things went for you when you started your channel and all that. And for me, I was thinking more along the growth lines, but they're blurred. We're
Mhm.
not there. That's why we have these conversations. Now, if you guys want to learn a lot more about the Cage ETF, or in the video that Paul did, you can look at them. They'll be on either side of the screen here. You pick which one you guys want to watch, and tell us in the comments if you like this content, and give us a thumbs up. Don't forget to follow Paul's channel, Better Call Paul. Leave it in the description below.